Welcome back to the Stablecoin podcast. We're your hosts, Luther Bidet and Rami Suleiman, co-founders of the Stablecoin Partners. Today's episode goes really deep into the plumbing of global finance. Our guest is Tony McLaughlin, founder and CEO of Ubix, and one of the clearest thinkers on why cross-border payments still look the way they do. Tony has spent years inside the legacy financial system and has been vocal about a core issue, that we've optimized messaging about money, not the movement of money itself. It's a system-level conversation about how money actually moves and why that matters. Before we get started, a quick disclaimer. The opinions expressed in this episode are those of the hosts and the guests and do not represent the views of their employers or affiliate organizations. This conversation is for educational purposes only and does not constitute legal, financial, or investment advice. With that, Tony, welcome to the show. It's such a pleasure to have you.
It's great to be here.
As we get started here, Tony, how did you get into this space, not just from the digital asset space, but more into the banking space? Because, there's some really cool things that you've done from the white papers that you've written at that time. Myself and Rami, we were all kind of similar. We started out from the TradFi world, but your entry into the TradFi world came from a banking side. Would love to kind of hear about that before we jump into the digital asset side.
Yeah, sure, Luther. I've only ever done one thing in my life, in my career, which is payments, working for different international banks. My first job was in 1993, working for Barclays Bank, and my first assignment there was working in the Traveller's Checks division. And ever since then, I've spent time working on every one of the TradFi rails, ACH and faster payments and SWIFT and, anything you can name TradFi. I've worked on that from a payments perspective. So I've only ever done one thing. And when you do one thing for 30 years, you have a think about how things are actually working. And you build up a mental model of what the current paradigm is and what that paradigm might be in the future. So that's it.
Yeah, that really helps from that perspective. But was there a point at which you said, this is broken, this has to change, and then you saw something where you said, this fixes what I thought was broken?
Well, rather than saying that something was broken, I can share that I have thought quite deeply over the years about what is money, and I've thought about the existing paradigm that we live in. And I very often I have this method where I try to see things from above. I just imagine, what if I was an alien observer of this planet and I was observing how things were working? And if you put yourself into that detached position and you just arrived in your spaceship today and looked down, you would see that these strange humans have organized their financial system in a particular way. And that particular way is there are these things called banks, and there are thousands of these banks all over this planet. And these banks receive their license from each of these things called nation states. And these banks are fundamentally balance sheets. What a bank is a set of assets and liabilities. And these banks record those liabilities on, databases in data centers. So that's interesting. So we're just observing what the setup is. And then something interesting happens, because when Rami wants to make a payment to Luther, a series of operations takes place. But the point of it is, or the net effect of it is, that there are balance sheet changes across different institutions to affect that payment. At the beginning of the payment processing, Rami's bank owes him $100, and at the end of the payment processing, Luther's bank owes Luther $100 or its equivalent in foreign currency. And so if you look at these things from above, you basically conclude that a payment is just a set of balance sheet updates, which is run on separate databases. And actually, there's this other entity in the middle called the central bank, and their balance sheet has to be updated as well. So then you ask yourself, is that the best way to run the railroad? Should you have all of these individual institutions with their individual balance sheets and their individual ledgers on different technical infrastructures? And should payments basically be about orchestrating those different balance sheet movements? So these are the kinds of things that you ask yourself when you're an alien like me.
Yeah, I totally understand. But how much of that do you feel like it's just an evolution, right? Like if this evolved differently, that would have been just what we got used to, right?
Well, maybe, but you can, again, even look at these deep questions with detachment. And let's say that on my planet, we don't have property rights. We don't have property. I mean, the idea of owning other
Yeah.
atoms doesn't make sense on my planet. But very, very deep in human history, they must have got this idea of ownership. This is my rock.
Yeah.
No, that's your twig. And then the legal system, if you think about the whole legal system, it's about establishing and managing property rights. What you own and what I own, and then contracts between each other to make exchanges. This is why I often think that blockchain is such an emotive subject, because what is blockchain? Blockchain is a who owns what machine. It's all about property. It's all about keeping track of who owns what. And we've been arguing over who owns what since we were sitting around the cave banging rocks together. So this is an evolution in a system which is built very, very deeply on a sense of who, property. That who owns what evolves through the technology. In one moment you're recording things on a paper ledger, next minute you're recording things on an IBM mainframe on a relational database, next minute you're recording something on a private permission blockchain, and then you're recording something on a public blockchain. But I agree with you that the fundamental is always about who owns what. And then in the financial system, we got this other thing that we invented along the way, which is not just who owns what, it's who owes what.
Well said.
That keeping track of who owes what is something that banks do. That's what their ledgers are, records of who owes what on the liability side of a bank balance sheet. They owe you the money, right?
Yeah.
So the deposit records is the record of them owing you. And then on the asset side of the balance sheet, they keep records of people who owe money to them because they've made loans. So this whole wacky financial system actually resolves down to record keeping of who owns what, and more pertinently, who owes what. And again, blockchain is so exciting to many people because it's a potentially new way of running that railroad and moving beyond the fragmentation of every bank being its own island, and the coordination of the balance sheet updates being effected through financial messaging, which you referred to before. So I in one way, I hate to be so abstract about it, but actually, if you just locate yourself in space and look down, it's not a bad way to try to see the patterns.
Yeah. I mean, I think you answered it right there at the end, I think, which is the technology allows for the re-engineering of a system that has spent thousands of years building processes in place because it wasn't able to record this stuff independently. That's the issue we've got to now. Well, that's this eureka moment now. We don't have the reasons why banks are so well capitalized is because they need to be capitalized because no one can see whatever anyone else is doing because everyone's got their own ledgers and everything has to be updated in a different way. And you're right. Once you get a centralized ledger that all the institutions can access and see everything in collective unison, that sort of removes the requirements for many of these institutions to exist, I would thought, and allows people to track all those payments, as you say, real time, independently, not have to worry about the credibility of a particular institution. Everything is there on the record,
Well, there's a couple of things you mentioned. Number one is blockchain. People might push back about the centralized, word that maybe more accurate to say that there is some kind of like common source of truth and common source of state. And of course, those are the two things that blockchain does well. Is again, it's a who owns what machine at each point in time. So it's capturing the state of of those obligations at any particular point in time. So that's good. The second question is whether the institutions have to exist, and that's where I'm not always convinced about this driver about getting rid of intermediaries or institutions. What is a bank? A bank is a balance sheet, which means it's a risk-taking institution. It's a risk-taking entity. And I would say that irrespective of which technology you use to record the assets and liabilities, having these risk-taking entities is a very valuable economic function, performing that maturity transformation between, they're like, banks are like suns. The sun takes simple elements like hydrogen and helium and makes more complicated elements, heavier elements, and so does a bank balance sheet. A bank balance sheet takes in the hydrogen and helium of your deposits and turns it into the carbon of a loan to an SME. So that transformation of simple deposits into risk assets, I think, is a very valuable function. And just because we're recording those things on common state engines, it doesn't, to me, mean that you don't need the bank anymore.
True. No, I agree with that. But what I would say is that it opens the door for new bank-like entities to create the same economic function.
Well, it opens the door to smart people to say, I'm going to reimagine the existing functions. I can do these things in a different way. And yeah, look, I think blockchain plus AI and lots of other exciting things happening in technology mean that we can endlessly reinvent. And that's the driver of capitalism. Capitalism is what Joseph Schumpeter called a process of creative destruction. Old forms are continuously replaced by new forms. That's great. Unless you're the one being disrupted.
That's very true. That's very true. I love the way that you kind of boiled it down to who owns what, who owes what, and all of that being tracked in a common state engine like a blockchain. Taking that, and let's dive deeper into how does Ubix solve this problem? Like, where does Ubix enter into this equation? I'll kind of seed this with the thought of, there are a lot of people that are in traditional fintech that say, I don't get it. We've had digital dollars for years now, decades probably. Like, why do you need all this new technology to track digital dollars?
Yeah. Well, the more people are exposed to digital assets, the less they tend. Let me say, I haven't heard anyone say that who actually interacts with digital assets.
Yep.
You might hear people say that if they've never encountered a MetaMask wallet or a Rabi wallet or a Phantom wallet. And what happens when you actually engage with that ecosystem is you can't help comparing your wallet, your crypto wallet, with your bank account. And you find that your crypto wallet can do lots more things than your bank account can do. Because in your crypto wallet, you can have things that look like money. You can have things that look like yield-bearing assets. You can have things that look like you can have cryptocurrencies. You can have stocks. The crypto wallet, the tokens and the chains. This is something also very powerful. People, their natural reaction is, the thing that I've got at the moment works fine, so there's no business case for change.
Yeah.
Now, I'm afraid to say, look, I'm 55. We're all of an age, right? So we grew up, and you had an alarm clock on your bedside table, and if someone said to you, in the future, your alarm is going to be inside your telephone, you would say, well, my alarm works fine. Why do I need my alarm to be a telephone? And then you also had a physical calculator. And if someone said to you in the future, your physical calculator is going to be in your phone, you would say, well, what calculation can I do on my phone that I can't do on my calculator? And you also had a Walkman or an iPod. And some say, well, in the future, all of this is going to be in your phone. You say, well, I can only listen to one song at a time. Why do I need anything better? But the truth is that those devices are gone, right? Those devices have been subsumed within a more general purpose technology. Now, I believe that tokens on chains have the same effect on legacy finance. So someone can look at an ACH system and say, why do I need something different from an ACH system? Why will it be tokens on chains? And someone can look at a faster payment system and say, faster payments does exactly what we need. Why should it be subsumed within tokens and chains? Or they can look at any other legacy instrument. They can look at credit cards and debit cards. Why do we need something different? Why will it be subsumed within tokens and chains? Well, these are the same people who didn't know why they would not be using their alarm clock, their Walkman, and their calculator going forward. And the truth is that general purpose technology, when given half a chance, subsumes the special purpose technology. So that's what I think is going to happen. Now, within that world of tokens and chains, there has to be a bridge between the token and chain world and the world of fiat currency. People will want to turn fiat currency into tokens and tokens into fiat currency, and that's where Ubix steps in.
I was going to say, just thinking about your analogy there, the icons that are in our phones to represent those relevant apps, our children don't know what those icons represent. They don't know what they look like anymore because it's with that
like the phone icon, you mean? Yeah.
Those icons,
yeah, the calculator icon, all the rest of it. Yeah, because they don't use the original.
Were hardware, right? Those icons were hardware, and they were special purpose, single purpose bits of hardware, and now they're subsumed.
Yeah.
And that's what's going to happen to legacy rails. I remember in 2008, faster payments was implemented in the UK, and it cost the industry many hundreds of millions of pounds in terms of the central switch and all the changes in the banks. Going forward, so here's the planning assumption I believe that people should make, is that going forward, everyone will have a wallet, and I hope that those wallets are provided by banks and fintechs and exchanges. I hope they're provided by regulated players. So let's just think about this. In a world where every bank, fintech, and exchange on the planet gives wallets to like everyone, every individual, every business, and those wallets are connected to multiple chains. The business case then for building a new faster payment system is going to be quite difficult to make, because you're going to ask yourself, what can I do on this faster payment system that I can't do with the tokens on the chains? So this is a flip, right? You have to imagine a world where everyone is connected through multiple chains from their bank. Now, in that world, I'm going to find it very, very easy to send payments to you, Luther, because I'm just going to take a stablecoin and send it to you directly. And that's not going to involve all of the balance sheet updates that we talked about before in the traditional system. So you have to imagine, what does the business case look like in 2030 for building a net new special purpose rail? I think it looks tricky.
Yeah.
But the proverbial penny will drop when the mass of people and businesses have been equipped with wallets connected to multiple chains.
So actually, I wanted to ask a question on that, Tony. How do you see that adoption curve happening so far? I hear some announcements from some banks that they are adopting wallet technology. We've both been inside banks. We know how slow some of them can be, and crypto and innovation have generally been skunkworks projects hidden in the corner of the bank, not really implemented. But we are seeing, our old alma mater city is being much more active on this stuff now, and lots of the larger banks are doing projects using token services and equivalents. Are you seeing a sufficient rate of adoption? When do you see, Barclays, the latest investor in Ubix, issuing a wallet to all of its corporates? What's your time horizon for that happening?
I think within 3 to 5 years, you'll see mass market rollout of wallets, and here's the reason. Here's the reason. So, you are a bank CEO, and this is the conversation we're going to have. Let's see if this logic let's see if at the end of this 60 seconds you're in the market for a wallet. Okay, so I'm going to try to sell. Leonardo DiCaprio, sell me this pen. I'm going to sell you this wallet. I'm going to try to sell you a wallet, right?
Let's do it.
So, Rami, you're the CEO of a large bank. Do you believe that in the future, we're entering a world where tokens and chains are going to be relevant? Do you see that tokens and chains going forward are going to be part of the financial infrastructure?
Yes, I can see that. Yeah, we can already see that's happening.
Do you know which chain or token will win? Do you have high conviction? So you don't know which token will win. You don't know which chain will win. Well, let me suggest to you that the thing that you can do, which is the lowest cost, which covers yourself against the greatest number of eventualities, is to get a wallet. Because the wallet is the bridge between your existing infrastructure and the world of tokens and chains. So you don't need to have any conviction on which token will win or which chain will win. But if you want to be relevant in the world of tokens and chains, the first thing you need to have is a wallet.
Mm-hmm. Yep, I see the logic in that conversation.
Is there any bank CEO who will not say yes to that argument? Now, it's just a question. And the reason why it's also quite compelling is the financial outlay to have a wallet isn't that great. It's not that great. And so if you're looking for I really plead with any bank or fintech who listens to this, who's at the moment living in the world of bank accounts or traditional accounts, the day after you've implemented a wallet, the day after you're able to give your customers a wallet, you can breathe a sigh of relief, because you will have future-proofed your institution for this new world. Now, again, you don't need to have conviction on which chain is going to win. Everyone's got different ideas. You don't need to have conviction on whether it's going to be tokenized deposits or stablecoin or which stablecoin. Everyone's got different ideas. But if you want to be relevant in this new world of tokens and chains, the wallet is the first thing to put in place. So I believe that's a very compelling strategic driver. The penny may have not dropped in every bank CEO's mind yet, but that combined with some other factors that we can talk about, I believe will lead to a world of ubiquitous wallets provided by banks and fintechs. And that will be a good world.
Yeah, I guess the only question I'd have is sort of what do you have there are lots of different wallets out there, single chain, multi-chain, MPC and all the other different types. Where do we go down that rabbit hole? Or I guess at a high concept, I absolutely agree with the thesis. I wonder whether the next question for the CEO is then how do you implement that, and which one of the myriad of choices, which wallet will win? I guess that's the next question.
Rami, you do recognize that if you're down into thinking about implementation, you've already been sold, right?
Oh, you've been sold, yeah. I know. I'm there.
You've bought the pen. I was there. You bought the pen. You just don't know whether you want a Beck or a Mont Blanc or something else.
Indeed,
but you bought the pen. And there's something that makes this not only like a strategic thing, it makes it very, very tangible commercially, which is that wallet is also your way of making money from stablecoins. And the way you make money from stablecoins, if you are that bank or fintech, is you catch the foreign stablecoin in your wallet, you convert it to local currency, and you make FX. Everyone loves making FX. So I said before that my first job was working on traveler's checks. Traveler's checks back in our day were accepted everywhere around the world. And the reason why they were accepted everywhere around the world is because, Rami, let's say you went on vacation with, did you ever use traveler's checks on vacation, Rami or Luther? Do you remember?
When I was young, very young, yeah.
Where did you go?
Yeah. When I first came to the States, I actually showed up with a bunch of traveler's checks.
So you came into the US and spent the traveler's checks in the US, but Rami, where did you use your traveler's checks?
So I went from the UK to, I think it was either Greece or Spain. I think it was one of those countries. Yeah. Right.
So let's just think about that transaction. You take your UK traveler's checks, which are denominated in sterling. Mm-hmm. You go to Spain, and in those days it was peseta. You walk into the Spanish Bureau de Change or the bank, and they're very happy to see you. And they're not very happy to see you because you're a British tourist or just because you're like charming guy, because you walk in and they make FX. And that's why the whole world equipped itself to accept traveler's checks. And the whole world will do the same thing for stablecoins, because every stablecoin, this is why I always say that American stablecoins are a gift to the world, because the American stablecoin comes into Singapore. And if a bank in Singapore catches that American stablecoin for its client and turns it into Singapore dollars, it makes FX. It's a very, very strong incentive for banks to get into that business. They love FX. And the only way they can get into it is by having a wallet. So there's a strategic reason for having a wallet, and there's a money-making reason for having a wallet. Everyone's going to have a wallet.
Yeah. We talked about digital assets. We talked about blockchain, which is the common ledger, as we called it. We talked about the various use cases here. Tony, if for somebody listening to this episode, to tie all this back to Ubyx, like how do you tie all these various concepts back into Ubyx?
Right. So let's talk about stablecoins and what I like to call the stablecoin game. It's the same thing. We take ourselves into space and we observe the stablecoin game. We see lots of funny things. So back in November 24, the state of the commentary about the stablecoin game is, well, stablecoins are going to be an oligopoly. There's only going to be a few issuers because there's a power law and there are network effects. And the whole world will be flooded with US dollar stablecoins, and it will lead to dollarization. And it's only going to be about dollar stablecoins, and there's no other currency which is going to be relevant. So you have to understand that when I hear those arguments about the evolution of the stablecoin game, I can't help but look at it in historical context and then think, well, let's think about the beginning of the credit card game back in the late 60s. There's only a few credit cards. They're American, they're US dollar credit cards. And you could make the same arguments about credit cards back in the 60s as you make about stablecoins today. It's going to be an oligopoly. There's only going to be two issuers. Everything's going to be dollars. If we were I was born in 1970. If in 1970 you made the argument that by the year 2026 there would be 16,000 credit card issuers on the planet, and every single currency would be represented, it would be crazy. But that's exactly where we are. And the same dynamics that led to the ubiquitous acceptance of cards around the world and a pluralistic market structure are inevitable when it comes to stablecoins. So what is the thing that unlocks that? It's a mutualized acceptance network. That's why the credit cards. That's why anyone can be an issuer. So Luther, if you start you start your fintech, Luther FinTech, and you launch a credit card, you launch a debit card and the stablecoin on the same day, you do not need to worry about the acceptance network for the card. You do need to worry about the acceptance network for the stablecoin. And so what Ubix does is we solve for the acceptance network of the stablecoin in the same way that the card schemes solve for the acceptance network of the card. So that's where we're going. And, look, I quit my TradFi MD 30-year, 10-year role because I had an uncanny feeling that I had real knowledge of the future. And that knowledge of the future is about how the stablecoin market, the tokenized deposit market, has to evolve. And there must be. Now, whether I'm successful, whether Ubix is successful in delivering this is up to God. But there must be a mutualized acceptance network for these instruments for them to be successful. Think of the world where every bank and fintech offers a wallet that then anyone can issue. There can be thousands and thousands of stablecoins and thousands of tokenized deposits. When you walk into, these days, Luther, you go on vacation, let's say into Japan, you take your debit card into Japan, the department store in Tokyo who accepts your debit card does not care about the issuer. They do not care about the issuer. And that's where we have to get to with stablecoins and tokenized deposits. The person or the business receiving the stablecoin or the tokenized deposit will not care about the issuer. And it's going to be a big evolution. At the moment, look at all the regulation, look at all the discussion. It's all about the balance sheet of the issuer. Now, again, someone's walking into Harrods just now, they're pulling out an Indonesian credit card. And Harrods doesn't give a damn about the issuer because that Indonesian credit card is part of Visa. That's where we're going with tokens. Has to.
We're in the infancy of the maturity, Luther. Do you know what's up?
The infancy of the maturation, as you call it, Rami. The concept that you're referring to, Tony, which has often we call it interoperability, right? The reason why somebody is able to take a card issued in the US and go use it is because there's interoperability at the hardware level, right? There's, whether it's a chip on the card, the way the point of sale works, there's interoperability at the rules level, right? And so Visa and MasterCard and Amex to some extent have done a great job of establishing those rules, to your point, where I think at one point they were actually called the trust networks, right? They were actually called trust networks because people didn't trust you or me walking into the store, no matter how good looking we may be, like Rami. But they trusted the fact that there is this little thing on the card that said Visa or MasterCard, and they said, that tells me that even though this guy is walking out with maybe $10,000 bag from Louis Vuitton, I will get paid $9,995 2 days from now for that thing that I sold, right? And that's the trust that they had from that perspective. And to your point, it is interesting how all regulations today, whether you look at the Genius Act that was recently passed in the US, some extension that's coming around from the Clarity side of it, et cetera, MiCA as a whole, you're right. And even from Stablecoin Partners and our sister organization, Stablecoin Standard, we looked at something called Stable Check, which looked at the efficiency, the solidity of the issuer, right? Like it was like, let's make sure that the issuer is strong. And this is something you bring up a very good point, because quite often people ask, how will people know which stablecoin to use? And I think we're asking the wrong question, right? It should be like, it shouldn't matter which stablecoin is used, as
Right.
long as, right, it's interoperable, like from that perspective. And I think as long
Yeah.
as somebody wakes, like if you went to sleep with $100 of USDC, USDT, Tony USD, whatever, and you woke up with 100, I think you're fine.
Yeah. Yeah.
Well, I was going to say a slightly different thing here, because in the previous construct, banks have balance sheets which bring trust, which means they're trustworthy institutions. At the moment, we've framed stablecoins as effectively being a balance sheet for money, and therefore they need to meet the same criteria to get that trustworthiness that allows people to use them. So I think that's why you've seen the legislation develop in the way that it's developed. But I think the next stage is not around the credit worthiness of the issuer. That needs to be proven anyway. The next thing that Tony's talking about is the interoperability and distribution, global distribution of those of said products. So I think, again, we're still at the infancy of this stage at the moment. We're still getting to that baby steps where everyone who wants to, because not anyone can issue a credit card, you know what I mean? Not anyone can be a bank to issue a credit card. So you need to meet certain criteria, whether it's capital or regulation, both, of course, to get to that stage. Once you're at that stage, then you can join this network, and then everything works in terms of distribution. I think stablecoins are doing the first bit first, which is, okay, we need these quasi-banks, narrow banks, whatever you want to call stablecoin issuers. Let's make sure they're regulated to the right level, i.e. similar to banks, and that's why you're seeing, Circle and all of these ones are going down the OCC route to become effectively banks. And then what Tony's doing is solving the next part of the equation, which is once they're all there, how do they talk to each other? Because I agree with you. I think we're going to get to this world where it's amazing how it's developed so quickly in the last few years. The moat was being the stablecoin issue and being regulated. Now that's not a moat anymore. Anyone can issue a stablecoin. Anyone can go to, we've had them on this podcast. You can go to Braille, you can get a white label, you can go to Bridge, get a white label. They're going to do the regulation part. So the key is then distribution. So once you've got Tony Coin or Luther Coin, how are people going to use it? How are you going to make sure that they can interoperate with each other? And we can't use the crypto ecosystem. I think the nice thing in the last 3 years is it's jumped out of the crypto petri dish gene pool, and we're now thinking about, how does it impact and how does it affect real world transactions? How are we going to re-engineer real finance? And that's sort of very exciting because it's a much bigger opportunity. But I think it needs both parts, Luther. You need to regulate the institutions, regulate the products at first, like the issuers. And then once you've got to that stage, jump onto Ubix or equivalent and then allow for the mutualized acceptance. I think that's the right order.
Yeah, I think that's right. And that's the same order that the cards networks went through. And, we humans have done this already, before with other technologies. We're going to do it with this technology. And what's required in that the Ubix role or the Visa role or the MasterCard role is neutrality. So no single issuer can do it by themselves. No single PSP or bank can do it by themselves. No chain can do it by themselves. It's really a collective endeavor to come together around a common rule book. That's a big part of Ubix's building. In fact, our rule book is on GitHub. It's something that will be a collective endeavor to agree that rule book. And also very important in this, the smart move early in the life of credit cards was to be one of the co-owners of Visa or MasterCard. And that's how it was before these companies did their IPOs. So if you look at the funding strategy for Ubix, and you mentioned the recent investment that came in, this is not random. This is because of the position that we want to be. We want to be owned by the ecosystem. What is the ecosystem? It's issuers. It's it's receiving institutions can be banks or fintechs or exchanges. The chains are absolutely vital. If I can make a point about chain go to market, because I've been on the receiving end of chain go-to-market. And let me suggest to you something which might be controversial in some quarters. So when I was in the bank, I had an endless stream of people from the chains coming into the bank saying, my chain is the best. And if a chain goes to market with a bank like that, you're forcing a bank to make a decision or pick a winner. They're not keen to pick a winner or make that kind of decision. Banks typically like to keep their options open. Otherwise, if they have to pick a winner, that evaluation process can take a long time. That can take 3 years because the bank wants to be sure. So I think that there is a different go-to-market for the chains. I think that the best go-to-market is to go to a bank and not say, my chain is the best. The best. What do we want? We want banks and fintechs to offer wallets, because that creates more endpoints for these instruments and the regulated endpoints for these instruments. So I think a better go-to-market is, again, the argument I made to you, Rami, before where you were playing the bank CEO. You need a wallet. That wallet is multi-chain. You don't need to pick a winner with respect to chain at this stage in the game. Now, every chain, again, believes that it's the best chain and they all want to be the first choice. But to get through the front door, I think it's better not to ask the bank to pick a winner, is my strong advice. I also think that it's good to lead with a use case. I think a very, very strong use case for every bank and fintech on the planet is to catch foreign stablecoins and convert them into local currency, because that is a money-making use case. Now, if we work together, if the issuers stop trying to go to an end, imagine you're an individual issuer and you go to a bank and you're saying, my coin is the best, only accept my coin. That's not the way the bank makes the most money, and you're asking them to pick a winner. If a chain goes to the bank and says, my chain is the best, only connect to my chain, then the bank is in paralysis because he's got 15 different people saying the same thing to the bank. So I think there's a different go-to-market for our industry. Don't try to get the bank to pick the best coin. Don't try to get the bank to pick the best chain. Get the bank to implement a wallet connected to all the chains. And then once we're all connected into TradFi, once Web3 and TradFi are properly connected, then the game begins. The competition between the tokens and the chains really begins once we're through the front door. But I think the industry is, because the go-to-market is at the level of the individual issuer or the individual chain, what we've actually done inadvertently is to hold up adoption, asking people to make choices that they don't need to make at this stage.
Yeah. The economic model isn't the right economic model at the moment for distribution, and the competitive angle between them is not right or not right.
Yeah.
But I want to bring up a point, actually. I think, me and you were lucky enough to be in Chicago a few months back. Do you remember? And we were on a panel in front of a room full of bankers. It was the Chicago Fed. And Tony asked the question, I remember, how many people have got a wallet? How many people have interacted with anything cryptocurrency? How many people have a wallet? Not a single hand went up, unfortunately.
Really? So this is 2 months ago.
Yeah, this is in October. Yeah, wow. October. Yeah. So we are really early, unfortunately. I think it's still a long way to go before the right people within the institutions actually access and interact with the technology to see the real benefits that can come downstream. So I think Tony's absolutely spot on in that. the movements, stablecoin standard and the issuers and the collective community of stablecoin, the stablecoin and tokenized deposit ecosystem should be one of education to just get people to use it. And it's not sort of use my particular one, or this stablecoin is the best, or this issue is the best, or whatever. I think it's just use digital assets some way, shape, or form within your organization, or even personally, just so you can sort of just get au fait with the technology, and then at that point it will all start to make sense, I think. But there's a long way to go.
But think about the adoption of streaming. Like what did streaming start? It started with BitTorrents and piracy.
Yeah, Napster. They did Napster and LimeWire and all the rest of it. Yeah,
right. But what proportion of the population were doing that stuff? Very, very small. But now, what proportion of the population is doing Netflix and Spotify? Very, very large. So there's also this thing about the association of the technology with a use case, and just like with streaming. The beginning of streaming was very, very much associated with criminal activity. And, people still have in their mind that crypto is basically associated with scams and, illegal activity. But just like streaming, the benefits of the technology in the hands of responsible players will come to the forefront. That's what's going to happen.
Yeah.
Now, the wallet that you get from your bank, I'm not sure it's going to be connected to prediction markets and perps to begin with, but a wallet from a bank, which is containing stable coins and tokenized deposits and tokenized money market funds and tokenized stocks, that's a good product. And those wallets might never see a cryptocurrency. That's okay.
Yeah. I like the way this is going. I had a question for you, though, before I lose my train of thought on this one. So if the argument to banks is that, you can make FX on the back of foreign stablecoins, but we live in such a dollar-dominated stablecoin world at the moment, what's the tipping point that will get the non-dollar stablecoins to get some traction? So, I was a GMO Trust, the yen stablecoin took a long time, not much traction. Even the euro stablecoins that have been issued by Tether and Circle are a fraction of their dollar equivalents. And, again, at Stablecoin Standard, we've got a multitude of non-dollar stablecoins, none of which even together are a rounding error on the firm size of the dollars one. So how do we change that narrative? Andy Adegant doing the UK stablecoin, for example, is a good example. It's a great product. Sure. How do we incentivize the ecosystem to start to support non-dollar stablecoins to get that adoption going?
Well, let's just take an example of, I'm sitting in the UK. Here's what if I had my druthers, here's what I would suggest to the UK would be a good strategy. First thing we do is we open up the entire financial system to dollar stablecoins. What does that mean? Every bank and fintech in the UK has a wallet, and we can accept the dollar stablecoins and convert them into GBP if we want to. Now that every bank has got a wallet, we can also accept Japanese yen stablecoins, and we can accept European stablecoins, and we can accept Singapore dollar stablecoins. And by the way, now that everyone's got a wallet, those same wallets can process GBP stablecoins. So the tipping point, Rami, that we're looking for is when every bank and fintech offers a wallet, those wallets can transact in any stablecoin or any tokenized deposit. Now, it just so happens that the US is doing us a favor by pumping their dollar stablecoins. So that provides us with the business case and the FX revenue to pay for implementing these wallets within our banks and fintechs. So that would be point number one about getting to this ubiquity. Ubiquity is coming. It doesn't, we can be like any of these predictions, when AGI, when driverless cars, when this, when that, when quantum computing, the date of it is not certain. The fact of it coming is high probability. And I can't see, I just cannot see the logic that doesn't lead to every bank and fintech on the planet offering wallets connected to many blockchains.
Yeah. I think, is it Bill Gates who said we overestimate what we can do in like 1 year, and we completely underestimate what we can do in 10 years. So I think you're right. Yeah,
absolutely.
Yeah.
Now, you just have to wear different hats to see the logic of this. If you are the central bank governor of Malaysia, and you anticipate that foreign stablecoins are coming into your country, where do you want them to land? Do you want them to land on an unhosted wallet, or do you want them to land on a wallet provided by your banking system? You want them to land, and this is what I call the Pokemon strategy. If you're worried about foreign stablecoins, you've got to catch them. You catch them in your financial system. I think that logic is undeniable, even at the central bank level. So all roads point to a world of wallets, and that means the bank account paradigm gets replaced by the wallet paradigm. And going back to the start of the conversation, we've got this world of proprietary ledgers. What is your bank account? What is your bank account? Your bank account, I mean, you look into your bank account, you see your balance, you think that's how much money I've got. But really what your bank account is just a line item in a relational database sitting on somebody's proprietary database. And that's and then that institution, they give you a mobile interface to see that balance, and they give you a web interface to see that balance, and they give you a way of manipulating that database by initiating transactions and receiving transactions. Okay, that's the paradigm that we've been living in for decades. That paradigm changes when you've got a wallet containing tokens and the wallet's connected to multiple chains. Then it's not a bank account centric world. It's a wallet centric world. And that's why, again, I really emphasize any senior bank manager thinking, what do I do? There's a lot of FOMO out there. Some people are saying, well, I must issue a token, or I must do this or that. The first thing that you do is get your institution sorted out with a wallet. Step number 1.
Yeah.
That's future-proofing. I'm not being sponsored by the wallet companies to say this, by the way.
No,
Maybe
but I
should
think
send money.
Right. But the way that he framed it is spot on, Tony, in that the wallet is the least risky way for a financial institution to get into this game.
Right.
And if you're not doing it, guess what? It's already happening. And it's happening maybe with people's own non-custodial wallets, at which point you have zero to little control. And now you actually do face flight risk, right? From deposit risk, deposit flight risk from that perspective. So I think that is very spot on. And the way that Ubix is providing, maybe to quote it in my words, providing interoperability across various assets and different chains is I think ideal. Is it safe to say that interoperability also comes with liquidity management, et cetera, from that perspective?
Yeah, right. I mean, look, we provide a very simple service. If you're a bank or a fintech and you receive these stable coins or these tokenized deposits, just think of Ubix as being a black box that turns them into cash. That's it. We just turn it into. So once you've got these two, you've got these two worlds, like the traditional bank account world, and then you've got the tokens and chains world. And existing institutions have to be able to straddle these two worlds. So that's just, you have to be able to do the same operations that you do today, straddling these two worlds. At the moment it's fiat in, fiat stored, fiat out. On the crypto side, you've got token in, token stored, token out. But when you combine those two things, you have to be able to do all the combinations. fiat in, fiat stored, token out, token in, token stored, fiat out. You just have a new set of permutations to be able to accommodate. But once your institution can straddle the traditional world and the token world, you're good. You're good.
Yeah. On that note, I wanted to ask you, Tony, how I know you've been advocating on this subject sort of internationally. What's been the reception? Because I think you've spoken to a few central banks, I believe, as well. So what's been the feedback? Have there been any themes from particular parts of the world where they've taken this on more so than others? Or what's your sense of, give us a summary of what you've been seeing.
My sense is that there's a tremendous amount of trepidation. I think people since the US election, people obviously noticed that as being a step change in where the industry is heading. I think that people accept that public permissionless blockchains are valid infrastructures for regulated players to work on. I think that the banks are extraordinarily keen that tokenized deposits give stablecoins a run for their money. And I think that the argument about catching the stablecoins into the regulated financial system just lands like giving a thirsty person a drink of water. I think that's accepted everywhere that we've made that argument. So, look, we're in a very, very interesting time for finance, Rami. To your point about the amount of innovation that's possible across these two rails, is tremendous, and you can see that already in the valuations that have come for some of the early participants. And there are certain things about the future market structure that are beginning to dawn on people. It's not going to be an oligopoly. There's going to be a many-to-many network. There are going to be many issuers, many receivers. Stablecoins, again, back to your point, are going to jump from the crypto ecosystem into general purpose payments. And that's going to be facilitated. I mean, one of the great things I think about the news of Barclays investing in Ubix is it's a signal. It's a signal that TradFi and Web3 are going to dovetail. That's what's going to happen. And TradFi and Web3 dovetailing is real when every bank and fintech offers a wallet. And that's coming.
Yeah.
So
this convergence is really, this is the exciting thing.
It's
I think
it's super exciting. It's super exciting. It doesn't mean the death of banks. It just means that these very interesting risk-taking institutions that we have on this planet conduct themselves on a new substrate. But that new substrate is got some powerful features.
Yeah. I mean, what did you think of the DTCC announcement sort of a few weeks back that, they're going to be using stablecoins on that side?
All announcements, great. But, without mentioning that specific one, all announcements, great. The real proof of the pudding is, I think, on the ground level, when we start to see the institutional adoption, the business adoption, the retail adoption. I think I look more for those types of signals than the kind of like press releases. Not to say, DTCC, I think, is very, very meaningful news, and another one of the signals. But I think the thing to watch for, there'll be very interesting partnerships, very interesting alliances announced, and you're just going to start to see real people and businesses transact with digital assets more and more.
Yeah, agree with that.
Yeah, and as we're trying to wrap up, Tony, I think this was a required conversation almost, right? For any bank or fintech person who is listening to this podcast to say, what is the lowest entry point, the least risky entry point that puts them in the game, that gets them a very a factual view on what exactly is happening, how the technology works, how the rails actually work, but more importantly, I think to your point, the risk is that if they're not doing it, they are definitely missing out because it is happening. Customers are adopting the technology and stablecoins in their own way, and in their own way is definitely not the way that potentially a bank would engage from that perspective, or fintech even from that side.
The right first move is probably not to issue an instrument. Probably not the right first thing for people to do. There's a saying that which is better to give than to receive. But when it comes to bank participation in stablecoins, it's better to receive than to issue. To begin with, that's the best way. That's the best place to begin, I think. Get a wallet, start receiving stablecoins, convert them into your balance sheet, and take it from there.
Yeah, I think it perfectly dovetails into how we started the conversation around what is a bank account, what are banks, and potentially what is a blockchain doing. It's keeping track of who owns what and who owes what. But in order for you to actually issue a loan, you have to have received funds first, right?
Yeah.
Like you can't really issue a loan with no assets under management, right? So from that perspective, I think it totally makes sense. So that's very cool. Any other parting thoughts from your side, Tony?
Well, thanks for the opportunity to talk to you guys and your audience. No, it's a collect. I'd say this is a collective endeavor. In our white paper, we use the analogy of this old folk tale of stone soup, which is about this. I don't know if you're familiar with this folk tale, but there's an impoverished village, and everyone is very downtrodden. It's raining, it's grey, a bit like London. And this stranger walks into town with a stone and says that he's going to make a fantastic soup for the whole village just using the stones. He gets one person to bring the cauldron and another person to bring the water, and he puts in the stone, he sets the fire, gets someone to bring the kindling. And the villagers are looking at this stone boiling in the water, saying that doesn't look like a very tasty soup. And he says, well, it would be a lot tastier if only someone could bring an onion. So someone brings an onion. And then he says, it would be a lot tastier if someone brings a carrot. So someone brings some carrots. And before you know it, everyone is contributed towards this communal dish, and everyone enjoys it. And the fact is that all of the ingredients were already there. And what was missing was the coordination layer. And that is true in our industry, in our digital assets industry. There are phenomenal resources available. There are huge resources available, and there is need. And what's required to bring these things together is coordination. Again, just back to my point of, if you're a chain, your natural thing is to go out and say to a bank, my chain is the best. Please implement my chain. If you're an issuer, you want to go out to the bank and say, please accept my coin. My coin is the best. But that's not the collective. That's not best for the collective. The best. There's a place for competing individually. There's a place to act in the collective best interest. And I think we have to follow the stone soup method. Get everyone to bring a little bit. Everyone to bring a little bit to the collective endeavor. What is the collective endeavor? Ubiquitous acceptance of digital assets. Every bank and fintech on the planet offering a wallet connected to all the chains. That's the place we get to, and it's a mutual undertaking.
That's the most well said, well put together way of kind of thinking about how our industry should be working. And also it kind of lowers the guard to some extent, because these are not new things, right? A lot of things, as you said, have already existed. It's just an amalgamation of what has already existed in just a different format from that perspective.
Absolutely.
Before we wrap up, Tony, where can people find you?
People can find me mainly, I guess, on LinkedIn. That's usually where I kind of hang out.
Fantastic. Thank you so much, Tony. It was great having you on the show.
Thank you.
Well, if you care about how money actually moves and why it still doesn't move the way that we expect it to, this is a conversation that's definitely worth sitting down and listening to. Definitely subscribe and follow for the next episode of the Stablecoin podcast. Thank you.